Hello everybody, and welcome back to my channel where I decode the signals of the market and empower you with financial wisdom. Today, we're tackling a question that's on every investor's mind. Should we worry about inflation? Before we jump into the topic, let's get a quick understanding of what inflation is. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Now, why is inflation on everyone's radar? My father used to say to me that inflation is the silent thief that erodes the purchasing power of your money over time. But is it the monster under the bed that many fear it to be? History has shown us that inflation can wreak havoc on economies. The 1970s saw skyrocketing prices and interest rates, making life expensive for consumers and businesses alike. But fast forward to today, and the landscape is quite different. In recent times, we've seen inflation rates ticking up in various parts of the world. Central banks are closely monitoring these trends, and investors are naturally paying attention too. But should investors be losing sleep over inflation? Let's break it down. Inflation can certainly have an impact on investments. When prices rise, the value of money decreases. This means that the returns on your investments might not stretch as far as they used to. For example, if you have money sitting in a savings account earning a low interest rate and inflation is outpacing that rate, your purchasing power is eroding over time. Central banks like the Federal Reserve and the Bank of England have tools at their disposal to combat inflation. They've been down this road before and have strategies to keep inflation in check. However, not all investments are created equal when it comes to inflation. Some assets, like stocks and real estate, have historically been considered good hedges against inflation. Companies can raise prices for their goods and services to match inflation, potentially leading to increased revenues and profits. Similarly, real estate values tend to rise over time, keeping pace with or even outpacing inflation. Experts argue that a little inflation is actually healthy for the economy. It encourages spending and investment, driving growth. But when does healthy inflation turn into a cause for concern? The answer lies in balance. As investors, we must be vigilant but not paranoid. Diversification is key. By spreading your investments across different asset classes, you can reduce your exposure to any single risk, including inflation. Another strategy is to consider investing in assets that tend to perform well during inflationary periods. These could include commodities like gold, which is often seen as a store of value during times of economic uncertainty, or Treasury inflation-protected securities, TIPS, which are specifically designed to protect against inflation. While it's true that too much money chasing too few goods can lead to inflation, the current consensus among central banks is that any inflationary spike will be temporary. As of early 2024, the United States has seen a slight easing of inflationary pressures. The Inflation Reduction Act, IRA, is contributing to this by accelerating the deployment of low-carbon technologies, which could have long-term economic benefits. However, the cost of living remains high, and the Federal Reserve's monetary policies continue to play a crucial role in managing inflation levels. The persistence of inflation means that Americans are still facing higher prices for everyday goods and services, which can strain personal finances, especially for those without adequate savings or investments to hedge against inflation. Also in Europe, the inflation situation has shown signs of improvement as of early 2024. The European Central Bank, ECB, has been actively managing monetary policy to ensure that inflation returns to its medium-term target of 2%. The ECB's decisions on interest rates and other monetary policies are based on a data-dependent approach, considering the economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. Even in China, inflation rates have been relatively lower than those in the United States. The Consumer Price Index in China hit a two-year high in mid-2023, but has since moderated. Despite the lower inflation rate, Chinese consumers are feeling the pinch due to a rebound in pork prices and other factors affecting the cost of living. For 2024, individuals are advised to review their financial strategies, considering the impact of inflation. This may include seeking investment opportunities that have the potential to outpace inflation, such as equities or inflation-protected securities, and being mindful of the need to maintain an emergency fund to cover unexpected expenses in a high-inflation environment. However, the cost of living may still be high, and the impact of inflation on savings and investments remains a concern. In conclusion, while inflation is certainly something to keep an eye on as an investor, it's not necessarily a cause for panic. It's about being prepared, staying informed, and making smart choices. Invest wisely, diversify your portfolio, and keep an eye on the horizon. Inflation is a factor, but it doesn't have to be a roadblock on your path to financial success. Thank you for watching. If you found this video helpful, give us a thumbs up. And don't forget to subscribe for more financial insights.